Dear clients, I'm Richard, Phillip CFD dealer. Last week, US broad-based equity benchmark index, the S&P 500, was shoved into negative territory for the year, precipitated by a heavy downdraft engulfing the high-duration, tech-oriented equity segment, after extending its unbeaten feat of marching higher in the month of March for the sixth time in this cyclical bull run. I believe one of the key triggers can be attributable to markets' contemplation of improved US rate hike prospects, as suggested by the hawkishness of the initial market interpretations during the first FOMC rate decision chaired by Ms. Yellen last month. Notwithstanding the subsequent dovish rollback on markets' misconstrued expectation of an earlier rate hike, provided by the release of Fed minutes on 9th of April, market concern over stretched valuation of high growth momentum stocks persisted, perhaps because it still makes sense for market participants to brace themselves early rather than late, as the fuel in the form of a suppressed low risk-free rate is eventually going to run dry. Hence, in the equity space, sector rotation out from high growth momentum segment, whose lofty stock multiples could be at risk of mean reversion, to the attractively valued old economy segment such as transportation, manufacturing, commodity related, seems to be an appropriate investment strategy for investors and is likely to continue playing out for some time. At the same time, the cross-market actions also depict a U-turn in market sentiment from the second half of March into the first half of April, amid the unfolding of several global risk events. These events include a shuffling US rate hike expectations as mentioned earlier, the policy inertia from the latest ECB and BOJ rate meetings, as well as the lingering Ukraine tensions. Therefore, globally, an overall heightening of risk aversion stoke investors' appetite for safe haven assets. Additionally, pricing readjustment, given the pullback of the imminence of an earlier US rate hike, also adds an impetus for investors to hunt for yield. Hence, last week, the S&P 500 and the MSCI All-Country World Index tumbled 2.6% and 1.9% respectively, whereas gold rose 1.2% and the Bloomberg Treasury Bond Index advanced 0.7%. Fortunately, market anxiety in the region was somewhat smoothed by a mini stimulus coming out of China. Now, so far this week, the US equity appears to weather the high duration, tech-oriented sector sell-off relatively better, with the backdrop of more encouraging economic numbers in retail sales, CPIs, jobless claims, which validates that the US economy is grinding northwards. We also have decent US corporate earnings results from Alcoa, Citigroup, Coca-Cola, Johnson & Johnson, Yahoo, etc., partly thanks to analysts lowering their S&P 500 earnings projection hurdle to -1% from an earlier anticipation of positive 6.6% back in January. Well, it remains to be seen whether markets' concern over stretched valuation would abate as the earnings season gets fully underway. If earning bids from key global proxy names continue to stream in, coupled with a low interest rate cushion conveyed by the latest Fed minutes, it should at least provide the equity market with some breathing space. Clients may consider using Phillip CFD to trade equities and indexes across markets to capitalize on trading opportunities in both rising and falling markets. In addition, we may also trade based on different strategies using many more benchmarks which are available with Phillip ETFs. Look forward to Monday's weekly Market Watch, where the topic is posted on PhillipCapital's Facebook page. Thank you for watching this week's Market Watch. I'm Richard from Phillip CFD. Tune in next week for more Market Watch videos.